The broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. My name is Bobby Rains. This is our once every 3-week Investors Observer members only workshop. Thank you for coming. Here's our agenda right now. We're going to look at some charts. I think I actually switched what else is happening and what's hot right now. In any case, it's going to be charts. We'll talk about what sectors and industries are hot right now, what else is happening in the market and the economy, and then the rest is member-driven content, questions, site demonstrations, and etc. We got a couple of good questions ahead of time, so thank you to those of you who sent them in. You can always send in questions ahead of time. Just reply to that invitation or use the help button on the website. As for today, there's plenty of time for questions. So if you have questions now or you have questions while I'm talking, go ahead and throw them in the question box. There's no real need to wait until the end. If you have a question about something that's relevant to what I'm talking to right now, I have 2 big monitors in front of me, and I usually keep an eye on the question box. So sometimes if you have a question about something I'm talking about in particular, I can answer it there in the moment instead of having to circle back. All right, all that out of the way, let's get started. Okay, so S&P 500. I think our last workshop was somewhere around the 7th of June. That would have been, maybe it's the 8th of June, somewhere in 28 days or 21 days ago. That would have been somewhere up here. We've gone down and then back up a little bit since then. We talked about this area as some support last time. In general, the 3,800 level seems to be a little bit like a magnet right now in terms of the market being kind of pulled and pushed toward that. But yeah, I think there's less going on technically than there is in the news department, let's say. All right, the NASDAQ is a pretty similar story. The numbers are different, but yeah, we had this big drop off a couple weeks ago, and then we've tried to come back, but it's been kind of in fits and starts. And this big drop off was really sort of the transition between, oh no, the Fed is going to tighten rates, to, oh no, we're going to have a recession. The Russell 2000 is similar. It's, peaked earlier than the other major indices after not really doing a whole lot in 2021 either. But the basic story here is the same. It fell off a cliff 3 weeks ago and is back up, although it didn't. It's sort of above this older low, but we still had a lower low here, which is kind of not the thing you look for. You'd like to see a higher low as a sign of a recovery. The S&P 500 versus the equal weight. So the reason to look at this chart is the equal weight counts all 500 stocks equally, whereas the S&P 500 sort of classic version is market cap weighted, which means that companies like Apple, Google, Facebook, Microsoft get a sort of outsized influence on the price. And so you can see that in some cases you get some divergence where the equal weight does better. This means that big tech companies aren't doing as well. And in cases where the equal weight is lower than the other one, it means the big tech companies are doing relatively better. We've sort of seen with the big tech, it looks like lag a little bit to the downside and then outperform a little bit to the upside here, but it's really been pretty close here recently in terms of how the performance has been, which led me to look for other things that might explain the sort of recent market action. Growth versus value is one way to look at that. Growth stocks tend to be stuff in the tech sector, but a lot of times it's stuff that is more speculative. The companies are a lot of times not even profitable. Generally, it's things that people buy because of the company's sort of future potential, whereas value, those typically tend to be companies that are currently profitable, have a proven track record, but maybe the expectations for them to be 2 or 3 times their current size in a couple years are significantly lower. So here you can see that value continues to outperform. It did get whacked, a few weeks ago along with everything else, but the sort of relative performance over the last year is pretty significant at this point. Yeah. And another thing we tried to look at is energy versus technology. This is just the XLE, which is the big energy stock ETF, and XLK, which is the technology ETF. The rise in energy here kind of hides the decline in technology, but you can see at the turn of the year, tech was up 12.75%, from basically a year ago today, and it's now down that much. So this doesn't look like a lot on this chart, but this is essentially a 24 percentage point decline, whereas the XLE was up more than 70% at its high, and now it's only up 30 something percent. But a lot of the delta has been there. Energy has been working, let's say, better than tech, although nothing seems to be working pretty well or very well on a reliable basis recently. There are a few things that have done, we'll say, relatively better in any case. So this is, sort of what's hot right now. These are the top sectors and industries based on Investors Observer's short-term technical scores, which you can see by going to stocks and then sector and industry. And you can actually see how they rank for each one of our proprietary scores here, but the short-term technical is the one I like to look at. It looks at the last 30 to 60 days, which gives you a pretty good idea of sort of what the mood in the market has been over the last month or so. All right, get this back up to full screen. All right, so in energy remains at the top. Thermal coal remains at the top of that. I've talked before, that's a little bit of an outlier. Thermal coal is relatively small in terms of what the number of players and who they are that are publicly traded at this point, but it does remain at the top. Oil and gas, E&P remains the second. Midstream is the second, which is is the third now. That's kind of interesting. Midstream is a lot of companies involved in like pipelines and storage of crude oil, sort of between the pumping it out of ground and the refining process. It's interesting to see those come up over like the drillers or some of the other industries that have been there. Utilities remains pretty much the same. It's independent power producers, regulated gas, regulated electric. That seems to me to be a sort of flight to safety. People are worried about a recession kind of play. Those are the stocks that people buy in that kind of environment. If you think about it, those are the bills people stop paying the last. Next up is basic materials, where we have coking coal, agricultural inputs, and lumber and wood products. Coking coal is different from thermal coal. Thermal coal is burned in like power plants, right? Essentially, it's thermal. It's used to make heat, which is used to make steam, which powers a turbine that makes electricity. Coking coal is used in the steel making process. And then agricultural inputs are things like fertilizer, Roundup, stuff like that. Lumber and wood products is exactly what it sounds like. Commodities have generally been kind of tight, although a lot of them have, we just looked at the energy stocks, those have gone down recently. Some of these have fared a little bit better because all the commodities are on a little bit different cycle. but yeah, that's kind of what's going on there. Financial services back on the list after I think not being on the list 3 weeks ago when we talked. That property and casualty insurance one is interesting. I think that's probably because of interest rates doing relatively well. Insurance companies, a well-run insurance company should take in premiums roughly what it pays out in claims, which means that it makes difference. It really makes most of its money by sort of investing reserves sort of between when you pay it in premiums and take it out in claims. Shell companies is an interesting one. We can look at that in a more detail in just a second. That's typically your SPACs. And then regional banks is the third one, which again probably has a lot to do with interest rates. As mortgage rates have gone up a lot, certainly a lot faster than they're paying on deposits, so they make some money on the wider spread there. And then real estate has been pretty steady on this list, although it's kind of sort of slowly slid down from the top or the second position where it was a little while ago. And its residential specialty tends to be REITs that are kind of a mix of things. And industrial is a lot of warehouse space, although I think that is also where some of the data center REITs come in. So let's go look at the shell companies real quickly, because I think what's going on there is a little bit interesting. All right, so we can go to shell companies. So these are all these things with acquisition corp in the name are SPACs, which is essentially, if you imagine the sort of traditional IPO process where you have a company and then you take it public in order to raise funds and create a public market for the stock. In this case, what happens is you hold an IPO and raise a bunch of money with the goal of finding a company to buy. And it's more complicated than that, but that's a good mental model. So most of these tend to go off at $10 a share. But if you look here, you'll see a lot of the prices are less than $10 a share. So this one, for example, if we go look at the chart over the last month, let's look at 3 months even. The stock's gone from 390 to, or sorry, 990 to 998, which is, a sort of slow and steady upward progression, but these things are trading below the par value, which in a SPAC, you can actually get your money back out. 3 months here. This guy had a weird spike a couple days ago, it looks like, but generally these are paying below what the stock is worth. So when they announce a merger, the shareholders can opt to either get their $10 back plus interest or be rolled into shares of the new company. So in this case, it's a little bit weird that all these are trading below $10, but as you can see from when we looked at a couple of charts, they've actually gone up some over the last couple weeks. And so that's why they rank relatively high, because they've sort of drifted up while everything else has been beaten down. All right. All right, what else is going on? I talked when we were looking at charts about the sort of shift from worried about higher interest rates to worried about recession. That explains, I think, that big drop in energy stocks, which had been going up even though the other things were going down. People buy gas when their interest rates are high. People buy less gas when there's a recession. So that seems to be largely what that's about. It is mostly just talk at this point. Even if you look at the estimates, you'll see, analysts at such and such a place have raised their prediction for a likelihood of a recession in the next year, but some of them have raised it to like 40%, which is still less than a coin flip. So I'm not sure how much stock to put in those really. The labor market and a lot of other measures remain healthy. There are some, consumer sentiment has certainly fallen. People don't like paying a lot for gas. They really tend to notice that in their monthly budget. And so that makes them feel bad about the economy. Can kind of be part of what's happening there. But yeah, it's far from certain, and generally a lot of things in the economy remain pretty strong. The sort of next most important thing going on is that interest rates, inflation, Federal Reserve conversation, which I think is separate from the recession talk, because the recession talk is really sort of people being worried about a thing that might happen, whereas this is a little bit real. We're starting to see what's known as the bullwhip effect in retail. If you think about how a whip works, or even just holding a rope and sort of making a whipping motion in it, you start with a small wave on one end, and it makes a much bigger motion on the other end. And so that kind of happens when you have these supply chain disruptions, where you start with a small shortage of things. And what companies will do is they'll put in orders to multiple places to try to get filled on something, right? So if I need 5 widgets, I might order 5 widgets from 6 different suppliers just to see if somebody can get me some widgets. And I might cancel those, or I may take delivery of all of them. But in any case, that puts orders for 30 widgets out into the economy, whereas I only really need 5. So production ramps up, and things like that. So you end up with getting a lot more supply. So we've seen recently in some of these comments from retailers, they have a lot of stuff, right? They suddenly all their stuff came in that they were waiting for, and now they have more stuff than they can sell, which means that we're likely to see some discounting. Turns out in inflation, in an inflationary environment, discounting means lower prices, which is the opposite of inflation, right? Inflation is higher prices. People putting things on sale tends to help with inflation. Now, this is going to be slower in commodities. Oil can ramp up. It's possible oil can ramp up relatively quicker. But copper, for example, it takes a long time to open a new copper mine and actually start, putting copper out into the economy. So it's less likely to happen there. Even, especially in things like agriculture, right? Like some crops get 2 crops a year, some only get 1. So you get a little bit less bullwhip effect, or it's on a longer time scale than there. But in some of the manufactured goods and things like that, we're starting to see a little bit of this bullwhip effect, which should help ease off on inflation to some degree, just because people are going to put stuff on sale because they got more than they need. The Fed has kind of a tough job here, in the sense that the Fed does not have tools to increase supply, right? Like there's no, yeah. The Federal Reserve can't make everybody's car use less gas, or tell everybody to stay home on Tuesday or anything like that. I guess telling everybody to stay home on Tuesday would decrease demand, but yeah, they have no tools to increase supply. And so hopefully they'll be responsive to sort of changing conditions in core inflation, which is the not food and energy prices part of the measure. Food and energy are obviously the things that most consumers care about the most, because they're the things that they probably buy most often, and they see the prices changing on the most. But those are also the things that the Fed has least control over. And so it's difficult for them to really do anything about those prices, because typically, and particularly right now, those prices are high because of supply issues more than demand, which they can suppress somewhat by raising interest rates. Oh, and the other thing that we're keeping an eye on is earnings season is coming. Tomorrow's the last day of the quarter. So we've had, a few sort of off-schedule reporters here recently, but that should start in earnest sort of the middle of July. So there have been a lot of cuts to forward guidance and cuts to estimates recently. That will probably make it easier for companies to beat estimates. That's kind of an interesting game that everybody plays. But people tend to focus more on guidance, especially in an environment like this where people are worried about a recession. Companies that are cutting their guidance will be seen as preparing for a recession, and so it's likely that those stocks will go down. Companies that can increase or that can raise their guidance or keep it steady will likely fare better, much more so than the sort of quarterly beat and beat or miss estimates game. The thing I like to do during earnings season is watch the market's reaction in the first few days. If a company beats earnings and cuts their guidance and the stock goes way down, that kind of thing can give you an idea of how the market is going to react to things for the rest of the earnings season. It doesn't necessarily mean, if the first 5 companies beat and lower guidance, it doesn't mean that all the companies are going to do that. But the way the market reacts to that kind of thing can be instructive for how the market will react to that kind of thing for the rest of the earnings season. All right. So Jim asked, what do you consider when getting out of, I'm pretty sure BPS means bull put spread here, which those are the trades you get emailed to you from the Investors Keyhole service. They're available in the stock screener as well. And so, yeah, I don't have a checklist such as it is, but as a general rule, what I always try to do is when it seems more likely than not that the stock will be below the strike price of the sold put at expiration, you should start looking for the exit. So you can act with sort of more or less urgency depending on the time to expiration, right? If your options expire Friday and it's Wednesday, you have not a lot of time to do something about it. If your options expire in August and it's the last week in June, you got a lot more time to sort of time that exit, look for an up day or something like that to try to get out the best you can. And the things to consider really in all trades are sort of stock specific factors, right? Like, why is the stock going down? One answer to that might be all the stocks are going down. In which case, in particular, if you have sort of that longer holding time available to you, maybe you don't want to dump it. If all the stocks are going down today and you think they're all going to go down tomorrow and your options expire Friday, yeah, maybe today's a good day to get out. But if you have a little more time, you can be a little bit more patient and wait and see what's going on there. But certainly if the market is otherwise doing relatively well and your stock is going down, that's not great. That's the kind of thing where you need to figure out why it's going down and maybe think about exiting there. So if you do have that longer time horizon, you can wait for, if you see a support level coming, you can wait and see if the stock will bounce off of there. You can also look for any known catalysts, right? So if earnings is coming, especially in something like a credit spread where your risk is relatively well defined, you can wait for earnings to come out, and it may push you back up to the point where you can get out and do a little bit better. So those are, that's the broad category of things to consider. I don't really have a set of rules because I don't think a bunch of hard and fast rules are a good way to trade over the long term. Different things. I've been around long enough that things have worked for a while and then stopped working, and then you find new things that work. And so giving out a set of sort of hard and fast rules just doesn't seem like a good idea. All right, a similar question. I know InvestorsObserver's potential option trades provide things like max profit, amount at risk, and break even, but it would be helpful if we had recommendation suggestions on when to consider exiting an option trade if things are going sideways. I realize this isn't hand-holding site per se, but if there's something like if the price of X reaches Y, consider exiting the position. It could be helpful for traders like myself and help for possible greater understanding of exit strategies going forward. So one thing I will say is there are a lot fewer trades, but you can follow along with the portfolio services if you're an elite subscriber. We send you everything you need to do there. We'll send you when to get in, when to get out, when to make any kind of adjustments by email, and they also show up on the site. So that's one thing you can do. The volume of trades is a lot less there, but that is an option to sort of follow along with and learn. The other thing, sort of to address the sort of broader question, is that each trader and strategy is different. And so it's really hard to give a, if the price of X reaches Y, exit the position kind of guidance, because frankly, I don't know why you got into the position. Right, vertical credit spreads, that's relatively well designed. You can, the previous answer, I covered that pretty well. But for covered calls and short puts, a lot of times people do that as part of what's known as the wheel strategy. In that case, stock ownership is accepted and planned for. But there are other reasons to do covered calls and short puts where you're not planning to own the stock. And so any sort of guidance I give would only be addressing some subset of people who are doing the trades. The diagonal spreads are very similar to the covered calls in terms of how they work and how they're structured. Obviously, if you replace a ownership of a stock with ownership of an option, right, you can hold the stock forever, whereas the option will at some point expire. So you have to treat it a little bit differently because of that. But you can sell multiple calls against it. You can treat it a lot like a covered call in a lot of ways. And yeah, all the things that I said on the previous slide are valid for all strategies, right? Like presumably if you made a trade, you like a stock. I guess if you made a bearish trade, you probably had a particular reason you didn't like the stock. In any case, yeah, if you like the stock and the market is no good, maybe stick with the stock. If something has changed about the stock, whether you were bullish or bearish on it, maybe that's time to dump it. And yeah, a quick note about the use of sideways in this question. He said exiting a trade if things are going sideways. My assumption here is he meant sideways in a sort of more figurative sense of not going well as opposed to actually sideways, because most of the trades that we publish here will actually make a full profit even if the stock doesn't go anywhere, which is sort of the stock trading use of the word sideways. All right, so we got a couple questions from Don. The first was, what do you think about cryptocurrency ETFs? And also, what about BITI, which shorts cryptocurrency? So I'm not entirely certain I understand the sales pitch for crypto ETFs. Like the idea of Bitcoin or Ethereum or a lot of the other cryptocurrencies is this is some kind of new replacement for money. And so if I buy that thesis, I feel like I would want to actually own that as opposed to owning a certain number of dollars worth of some vehicle that held that thing, if that makes sense, right? Like if I believe in the Bitcoin sales pitch, I would, I think, prefer to own Bitcoin than an ETF that hold Bitcoin, because Bitcoin is exchangeable for things, whereas the Bitcoin ETF, all I can do is trade that back into dollars. Now it might be more or less dollars at some point in the future, but if the reason to buy Bitcoin is because Bitcoin is a new kind of money that will be worth more than the dollar in the future, then I feel like I would want to own Bitcoin more than I would want to own a claim on some number of dollars in the future. The other thing I'll say about crypto ETFs is a lot of the cryptocurrency ETFs are not actually holding cryptocurrency. There are a couple of Bitcoin ETFs that track the Bitcoin futures. There's also the Grayscale Bitcoin Trust, which is kind of like an ETF, although it is different in a few ways that I would categorize as plumbing. But yeah, a lot of them are holding stock in companies that are involved in the crypto or blockchain space. Now, these companies might do something at some point, but there's a really wide range of businesses happening here. And that includes, companies that are trying to use blockchain technology to develop products or provide some kind of service, but it also includes things like this company MicroStrategy, which makes sort of productivity software and also just buys and holds Bitcoin. Which again, if you want to own Bitcoin, I would suggest owning Bitcoin as opposed to owning a proxy or claim on someone else's Bitcoin. And the other thing that I will say about the blockchain companies is that blockchain has been around for more than 10 years yet, or more than 10 years at this point, and at no point in my daily life have I come across anything that I needed Bitcoin or blockchain to solve. The iPhone, it turns out, came out 15 years ago this week. Think about how ubiquitous iPhones are now, or smartphones are now, or even how ubiquitous they were 5 years ago, right? Like they've ruined all TV shows and movies from the 80s and 90s because the plots are easily solved by people being constantly having access to the internet and being able to communicate with each other in real time, regardless of where they are. So that adoption was rapid and extremely widespread. And yeah, Bitcoin's been around for 11 years, and I have yet to see a reason why I need to get involved. Other than actually owning Bitcoin, there's nothing I can do that requires me to own Bitcoin. And the thing I will say about the short ETFs is that they tend to have higher fees than traditional ETFs, especially something like a cryptocurrency ETF. You can't actually short it. So they buy futures, and there's some costs associated with rolling it. It may be fine as a trading vehicle, but generally sort of not believing in Bitcoin isn't really a valid short thesis because, like I said, there are fees involved. So yeah, early and right tends to be still wrong in terms of trading. So I'm not, do what you want, but I don't see any reason to be short cryptocurrency either, other than maybe as a as an investment. And Chinese stocks. So the reason to buy stock is that stock ownership entitles you to a share of future profits. And so before buying Chinese stocks, I think you should consider what is the likelihood that the Chinese government allows large transfers of wealth from Chinese citizens to American investors. Right? So presumably the Chinese stocks are doing some business in China. They're collecting money from the people in China. And what are the chances that the Chinese government will let that money flow out of China and to US investors? I don't think it's super high personally. Your analysis and mileage may vary, but yeah, that's where I am there. We've also seen some cases of what I would call arbitrary governance. Right? I think we all know what happened to Didi, the sort of Chinese ride-sharing company that did some things the Chinese government didn't like, including having an IPO in the US. And the Chinese government said, okay, you're not allowed to have this app in the App Store in China, which will kill your app-based business, it turns out, or at least really squash it. So new rules can come out at any time, and companies have little to no recourse. This also happened with a lot of the sort of online education companies in China. The government said essentially a lot of these activities were not allowed to be conducted for profit anymore, which not having ownership of future profits makes it hard to not being able to operate your business for a profit makes it hard for the investor to get a share of future profits. And the other thing is, as an American, I'm not necessarily opposed to free trade or anything like that, but financing Chinese technology and infrastructure building, especially when there are similar opportunities in the U.S. or some country that I feel like is probably less likely to be hostile to me personally or me as part of a group in the future. I'm not, I personally, again, am not super interested in that. So, yeah, that's sort of my take on the Chinese stocks. All right, so that's all the questions we got ahead of time. Let's see what people said. So Melinda says, what do you think of bank stocks? Wells Fargo, Bank of America, JP Morgan. The bank stocks have, everything's been kind of beaten up recently. I think earnings are going to be interesting. I think, this quarter had some volatility, but not a lot. It was pretty much just a steady march lower if you look across the quarter, which isn't great in terms of how those companies' trading businesses do. The other things are things like loan originations, where those companies make a lot of money, are down, both on the new purchase and on the refinance side. And they're among the first to report in the earnings cycle. If you're trying to build a well-diversified portfolio, I think bank stocks probably have a good place in terms of do I think they're going to, blow out earnings and pop by 10 to 20%? I have no idea. My guess is, my guess is probably not so much in that case, but we'll see. All right, so any other questions people have, you can go ahead and put them in there. We have an anonymous commenter who I guess disagrees with me about Bitcoin and also wants to point out that Luckin Coffee is at a new all-time high. Luckin Coffee is a Chinese coffee company that was halted for a good chunk of 2020 because their financial statements were fraudulent. They're back, and apparently the stock is at a new all-time high. They have not yet returned any money to shareholders, and I don't know that they have been audited by American authorities yet. So, sure. I don't think that discredits anything that I previously said about Chinese stocks. While I'm waiting for more questions to come in, this session is being recorded. We'll get the recording up later this week. We'll put it on the website, and usually we send an email out to everybody to let them know that it's available. It ends up just being a YouTube video that's posted on the site. So it's easy to watch, and you shouldn't have any trouble watching it on whatever device you choose. Let's see, we have a bunch of videos on how to use the website. Sorry, Denise asks, are there videos on how to use the stock screeners? If you look in the Help Center under stock analysis scores and stock screeners. Anything that has this logo next to it does have a video. So how to use the stock screener in the preset screens, top five stocks page by category, and how to use the compare tool. We do have videos for all of those, as well as videos explaining what a lot of our scores are. And that's, again, under Help Center on the website. All right, I'm not seeing... Okay, here's another question. Justin says, are there options tools with the Options Elite package? Sure, so Elite Options gives you access to our option portfolios. We only have 2 trades open right now in the diagonal spreads portfolio. Those are, again, the trades that I was talking about where you get guidance open to close. You also get our featured trades every day, which are 3 usually covered calls. Sometimes there's a short put in there, as well as what we call our personalized trades. You can pick from any of these categories and see 3 trades on there a day. There's also our options screener. You can screen for trades in any of these 7 strategies. You can also find those strategies on the individual stock page. This is Kroger, for example. And then on the stock page, we also have enhanced option chains, which can help you find a covered call or a diagonal spread on an individual stock, or our out-of-the-money calculator, which helps you find an out-of-the-money call to sell against a stock. So let's say you bought Kroger at 55, and you're a little bit underwater on it, and you want to sell a call that will help you get back above water. This call has a 27.6% chance of assignment. And brings in, it looks like $1.43, so that would lower your cost basis to 53.66. And again, it's relatively unlikely to be assigned, but even if it is assigned, you still come out profitable there. All right, so Charles says, what do you think some of the best trading strategies might be, assuming we soon enter a formal recession that lasts a year or so? Charles, a year would be a pretty long recession. Recession, the definition of a recession tends to be 2 or more quarters where the economy contracts. And so a year-long recession would be 4 quarters of contraction, which would be pretty long, and I would assume relatively severe, which I don't think the fundamentals of the economy really, or at least right now, really support that case. But yeah, I mean, the best trading strategies in that case are, I don't know, you can find some things to short, right? Presumably the recession in this scenario is caused by high interest rates. You can try to find dividend payers, something like maybe a CD ladder with relatively short term, expiry, so you can take advantage of, you can keep adding to that position as the rates go up and not be locked into a low rate for a long term, something like that. But yeah, I feel like this is a relatively unlikely scenario, just from my own impression. It's not a thing that I've spent a lot of time thinking about or worried about. I mean, just sort of generally, we've been I would say broadly cautious recently. If you look at the trades we've done, it's, fertilizer, CVS, United Airlines, big mature companies. The fertilizer play hasn't turned out that well, just because we kind of top ticked the market a little bit, but the other two have done okay. So yeah, things like that, right? Like Coca-Cola has done pretty well this year. Things like that, right? Utilities, that kind of thing tends to do good in all markets. They get overshadowed in a bull market because other things do way better, but it's not like those stocks go down in a bull market. They just maybe don't go up as much. All right, so Petra asked about Telecom. Telecom is interesting, which, yeah, that's not where I was trying to go. All right. If we go to communication services and look at Telecom, yeah, so a lot of the offshore companies are doing better. T-Mobile, I would have to look at to see. T-Mobile seems to have done okay over the last year. Verizon and AT&T have just been on a pretty steady march downward. For reasons I think they have sort of different problems, but they're linked. In terms of they both got into a lot of content and a lot of other sort of things that are maybe ancillary to the core telecom piece of the business. And those have not been great. The dividends have gotten pretty high. Verizon, I think, is close to 5%. I think AT&T is probably a little bit higher, although I've seen some rumblings that AT&T might have to cut their dividend after the Warner spinoff. So we'll see there. Again, those are the kinds of things that people buy in a recession, right? Like, having a phone has become practically essential in modern life. So yeah, I mean, those stocks can go down, but if you're getting paid 5% a year, they're relatively safer than some other things, certainly. And after having been beaten up this bad, one wonders how much longer they can keep going down. Yeah. All right, well, I'm not seeing a lot more questions coming in. Like I said, this session was recorded. We'll get the recording up later this week. You can send questions to us anytime. You don't have to wait for the workshop. Hit this help button, put in your email address and a name and a question. That question goes in under how can we help you. We get back to most of those pretty quickly. Thank you to everybody who submitted questions ahead of time. By all means, you're welcome to submit questions ahead of time for the workshop. You get typically, I think, a more coherent answer that way as opposed to just me talking off the top of my head, but I'm more than happy to do either way. The next workshop will be in 3 weeks, which is July the 20th. Thank you all for coming, and thank you for subscribing to Investors Observer.